Okay, let's get straight into it. This is just about buying calls. Okay, there are two basic products in options. There are calls and there are puts. Okay, there are four fundamental positions based on those two products. You can buy calls, sell calls, you can buy puts, and you can sell puts. Okay, in this video, we're only looking at buying calls, all right, going long calls. When you buy something, you will pay for it, all right, and you receive the right to buy. Okay, call is the right to buy if the price goes up. That should be locked in your memory, that statement. A call is the right to buy if the price goes up. Okay, the buyer of the option does not have to action their contract. You can buy 1,000 calls. Okay, you can buy lots of contracts to buy Telstra at $3.50 and it can go to $4 and you never have to action that. You don't have to do anything. Okay, you have the option. Okay, but if you do have the opportunity to buy Telstra at $3.50 when it's trading at $4, you would take it. Okay, that contract is called in the money and you would straight up make 50 cents by actioning that contract, you would do it. Okay, so whoever buys the call has the option to buy. Whoever sells you that options contract has the obligation to provide liquidity. Okay, so if you have the right to buy Telstra at $3.50, that means somebody sold you that right. Whoever sold it to you has the right or the obligation to sell it to you at $3.50, no matter how high it trades. Okay, so even if it trades to $10, that person that sold you that options contract has to sell it to you for $3.50. Okay, now you do not have to hold an options contract through to expiry. You can sell it the very next day if it's worth any money. You can sell it the next day even if it's not worth any money, if you can get somebody to buy it. The core concepts of every options contract, every single one that you'll ever buy, these will be the core concept. Okay, is it a call or is it a put? Did you buy it or did you sell it? What's the strike price? When does it expire? How much did you pay for it? Also called premiums. You pay premiums when you buy an options contract and you receive premiums when you sell them. Okay, now is the contract in the money or out of the money? In the money means you have the right to buy Telstra at $3.50 and it's currently trading $3.60. Okay, so you get to buy it 10 cents cheaper. It's 10 cents in the money. Out of the money means you have the right to buy Telstra at $3.80, but it's only trading $3.60. Okay, it's 20 cents out of the money. Okay, in of the money, out of the money means does it have any inherent value? Do you get to buy that stock cheaper if you actioned or if it were to expire right now? Okay, I wanted to show you this. This was what I saw today when I was trading Telstra. This is what I see. When you trade options, this is what you see. It's called an options chain. Okay, I just wanted to run through these things. Code, bid, open interest, volume, last trade, exercise price. Okay, all across here. Telstra is trading $3.79.5 today. Okay, these are the different expiries that you can purchase. The codes are overwhelming. You do not ever need to memorize or understand the coding system. You never need to worry about that, don't worry. The bid and the offer are basically the best price. Okay, the offer is people who are selling these, and the bid is the people who are trying to buy these. So this is how you figure out what you'll pay. You'll usually pay somewhere in the middle of these two, or if you're in a hurry, you'll just hit the offer or the bid. That will make more sense as we go on. Open interest and volume and last trade, not critical right now, and they should make sense. Exercise price should be fairly intuitive also. Okay, examples. This is Telstra. It's important to know that this is not a chart of the price of the options. This is the price of the underlying stock. So Telstra itself. So on the 31st of October, this is what the price did. So it fluctuated between 380 and 382 pretty much. This is this is 1 hour, 1 hourly chart. So each of these candles represents a bar, and each of these columns represents a day. Okay, if you're unfamiliar with technical analysis, there's plenty of other YouTube content on that. I won't dwell on that. I'll just assume you know how to read a chart. Okay, so if we bought a call on November 1st with a $3.80 strike price, okay, so that's literally this. That is this call right here, $3.80 strike price. And the way that they're priced, it's 0.04 multiplied by the number of shares. So 0.04 times 100, you would pay $40 for this options contract with an expiry exercise price of $3.80 and an expiry on the 30th of November. These don't line up, by the way. This chart is old, and this screenshot was taken today, I think. But assume these dates. So if we bought a Telstra call on November 1st with a $3.80 strike price, so that's about on the money. Okay, it gives us the right to buy 100 Telstra stock at $3.80 per share. When it expires on Thursday, November 2nd, it's worth $3.85. So if we were to exercise our right to buy 100 Telstra shares for $3.80, we'd be getting a 5-cent discount. So we could take those shares and straight away sell them for 5 cents more than we paid for them. Okay, or we could just sell the option. We don't have to hold the option through to expiry. You can sell these calls straight back. So these ones are in the money. There's a $3.60 call. We could sell that straight back to the market. We never actually have to take ownership of the shares. We don't have to hold the option until it expires. Okay, so if Telstra had not gone up, all right, so we bought it on the 2nd, or Wednesday the 1st, so we bought it down here. All right, so if the price had have come off instead, we would have paid $40 for an option that gave us the right to pay $3.80 for 100 stock. We wouldn't do it because the price went off. Okay, if it was trading $3.60, we'd just go to market and pay $3.60. Okay, that's what we call our option expiring worthless. Okay, another example, if we bought on the 7th, down here with a strike price of $3.80, and then on the 9th, okay, when it expired, we would be, okay, so $3.80, it expires at $3.90, we're 10 cents in the money. We'd be paying $3.80 for 100 shares that are worth $3.92. So we could instantly flip those shares. We could turn around and sell them back to the market for a 12-cent profit. Now, we would do that. That's obviously, we're going to do that. We've basically just, it's like buying a Toyota Corolla for 10 grand on Tuesday and then selling it on Wednesday for 15 grand. We're going to do that. That's what the trading game is. Okay, but a losing example, if on the 3rd, so the price is trading around here, 388. If we bought a 390 call, okay, so it's slightly out of the money, we're going to get it cheap. But on the 7th, the price has actually come off. Okay, our option is worthless. We're not going to pay $3.90 for stock that we could buy for $3.84 per unit. Okay, so in that case, we would have spent $40 on an options contract that expired worthless. That's the risk when we trade these things. Okay, here's a monthly chart of CBA. Okay, if we bought a call in May with an expiry in late June, okay, that's another thing I want to tell you. These things expire weekly. For the more popular ones, the ones that have options weekly, they expire weekly, but you can buy them months ahead of time. You can buy an options contract with a 12-month expiry. Okay, it doesn't expire until November next year. Okay, this thing goes all the way down, and you can buy them at a lot of different prices. Okay, the further out of the money it is, the cheaper you'll get it. So if we expanded this open here to have more than 6 strike prices, okay, Tesla's trading $3.79 today. We could buy a $4 call. Okay, now because it's 20 cents out of the dollar, out of the money, we're going to get it really, really cheap. Okay, we could also buy one that's already in the money, which basically means it's already worth money. We could sell it right now, or if it expired today, it would pay us. But we're also going to pay a lot more for that, because this is a $10 contract, this is a $220 contract. Huge difference, all right? And that's where we get in and out. That's how we play this game. July with a mid-September expiry. So mid-July, $102. Okay, when the price shoots straight up to $106, you're probably going to cash in then. The difference between here and here is called the time value. Okay, so long as there's time left on an option, it could do anything, and so it's worth more money. You know, the uncertainty factor has a dollar value. It's called the time value. Okay, the intrinsic value, that's the other one. So the difference between what you bought it at, $102, and its current price, that's called the intrinsic value. Okay, finally, you would buy a call. A call is a fundamentally bullish move. You would buy a call if you expected the price to go up. Okay, if you think your stock will go up and you don't have enough money, say you want to buy Commonwealth Bank shares, they're $100 each, right? The minimum purchase in any stock is $500, so you can buy 5 of those. Okay, so even if you bought 5 of those and they went up $1, $2, you're still not going to have a lot of. You need a lot of money to buy all those shares. With options, specifically call options, you can buy a whole bunch of call options for a fraction of the price that you would buy the stock. So you don't actually need a huge amount of money to play this game. You never have to let an option expire. You never have to action it. You can just play around and speculate for a fraction of the price. The other times you would use it is when you want to lock in the current price and as part of a multi-leg option. So sometimes you will buy 3 of these options, sell 2 of those, sell 2 of those, and buy 4 more of those. And that, somewhere in amongst all of that, there's a very, very valuable combination. So multi-leg orders, that's eventually where you would get to as an advanced trader. Okay, so this one's been about specifically only buying calls.